The year was 1907. A sense of unease settled over Wall Street. Whispers of financial instability turned into shouts of panic. The trigger was a failed attempt to corner the market on United Copper Company stock. This sparked a chain reaction. Trust evaporated. Depositors stormed banks demanding their money. The American banking system teetered on the brink of collapse. There was no lender of last resort, no entity to provide emergency funds and restore confidence. The crisis deepened with each passing day. Businesses failed. Unemployment soared. The nation desperately needed a solution. Amidst the chaos, one man emerged as a beacon of hope, J.P. Morgan. A titan of finance, Morgan used his personal wealth and influence to shore up failing banks and stem the tide of panic. He orchestrated loans, brokered deals, and single-handedly prevented a complete financial meltdown. However, the episode exposed a glaring weakness in the American financial system. The Panic of 1907 made it painfully clear that the United States needed a central bank. A central bank could provide stability, act as a lender of last resort, and prevent future crises. The question was, what form should this central bank take, and who would control it? The American financial system of the early 20th century was fragmented and vulnerable. Unlike European nations with established central banks, the U.S. relied on a decentralized network of state-chartered banks. This system was prone to panics and bank runs. There was no mechanism for coordinating a nationwide response to financial distress. The National Banking Act of 1863 had created a system of national banks, but it had its limitations. It failed to provide for a flexible currency supply or an effective way to manage reserves. The Panic of 1907 exposed these shortcomings with brutal clarity. Senator Nelson Aldrich, a powerful figure in Congress and father-in-law of John D. Rockefeller Jr., recognized the urgent need for reform. He understood that a central bank could provide stability, regulate the money supply, and act as a lender of last resort in times of crisis. However, the idea of a central bank was met with deep suspicion by many Americans. Populist politicians and farmers feared a central bank would be controlled by Wall Street interests, further concentrating power in the hands of the wealthy. They argued that a central bank would stifle competition and disadvantage rural communities. The challenge was to design a system that addressed these concerns while providing the necessary financial stability. In November 1910, a secret meeting took place on Jekyll Island off the coast of Georgia. A group of powerful men representing Wall Street and the U.S. government gathered under the guise of a duck hunting trip, their true purpose to draft a plan for a central bank. Senator Aldrich led the group, which included prominent figures like Abraham Andrews, Assistant Secretary of the Treasury, Paul Warburg, a partner at Kuhn, Loeb and Company, and Frank Vanderlip, president of National City Bank of New York. They worked in secrecy, fearing that public knowledge of their meeting would derail their efforts before they began. For 2 weeks, the men debated and negotiated, hammering out the details of what would become the Federal Reserve Act. They drew inspiration from European central banking models while trying to create a uniquely American system. They agreed on a decentralized structure with regional banks, a concession to those wary of concentrating too much power in Washington. The Jekyll Island meeting was shrouded in controversy from the start. Critics denounced it as a clandestine gathering of Wall Street elites, plotting to control the nation's finances. The secrecy surrounding the meeting fueled suspicions and contributed to the perception that the Federal Reserve was being imposed on the American people without their consent. After years of debate and compromise, the Federal Reserve Act was signed into law by President Woodrow Wilson on December 23, 1913. The act represented a landmark achievement in American financial history, creating a central banking system for the United States. The Federal Reserve System, as it was known, was designed to be a hybrid entity, incorporating both public and private elements. 12 regional Federal Reserve banks were established across the country, each serving the needs of its district. A central governing board, the Federal Reserve Board of Governors, was created to oversee the system and set monetary policy. The board was to be appointed by the President and confirmed by the Senate, ensuring a degree of public accountability. The Federal Reserve Act was a testament to the belief that a central bank could provide stability, regulate the money supply, and act as a lender of last resort in times of crisis. Its creation was met with mixed reactions. Supporters hailed it as a vital step towards modernizing the American financial system. Critics remained skeptical, fearing that it would ultimately benefit Wall Street at the expense of the common man. The true test of the Federal Reserve would come in the years that followed, as the nation faced the unprecedented challenges of a world war and a devastating economic depression. The Fed's actions during these tumultuous times would shape its legacy and its role in the American economy for decades to come. The Roaring Twenties were a time of economic prosperity and excess. The stock market soared to dizzying heights, fueled by speculation and easy credit. The Federal Reserve, still in its infancy, faced the challenge of managing this speculative boom. Some economists argue that the Fed's policies, including keeping interest rates low, contributed to the unsustainable bubble. The stock market crash of 1929 ushered in the Great Depression, the worst economic crisis in American history. Banks failed, businesses shuttered, and unemployment skyrocketed. The Federal Reserve, tasked with providing stability, faced its greatest test yet. The Fed's response to the Great Depression is a subject of intense debate among economists. Some argue that the Fed acted too cautiously, failing to provide enough liquidity to the banking system and stem the tide of bank failures. Others contend that the Fed's hands were tied by the gold standard, which limited its ability to expand the money supply. Regardless of the specific criticisms, the Fed's actions during the Great Depression are widely seen as a failure. Its inability to prevent the collapse of the banking system and the prolonged economic suffering had a profound impact on its reputation and the public's perception of its role. Today, the Federal Reserve stands as one of the most powerful central banks in the world. Its decisions on interest rates, bank regulations, and monetary policy have a ripple effect across the global economy. Its primary responsibilities include conducting monetary policy, which involves setting interest rates, buying and selling government securities, and lending to banks to achieve stable prices and full employment, supervising and regulating financial institutions, ensuring the safety and soundness of the financial system by setting rules for bank capital, lending practices, and consumer protection, maintaining the stability of the financial system by acting as a lender of last resort, providing emergency loans to prevent financial panics, and providing financial services like clearing checks, processing electronic payments, and distributing currency. The Fed's power and influence have made it a subject of ongoing controversy. Critics argue that it is unaccountable, prone to political influence, and its policies often benefit Wall Street at the expense of Main Street. Supporters maintain that the Fed plays a crucial role in maintaining economic stability and preventing financial crises. The Federal Reserve's most potent tool is its ability to conduct monetary policy. This involves managing the money supply and credit conditions to influence economic activity. The Fed has several levers at its disposal. The federal funds rate, which is the interest rate that banks charge each other for overnight loans. By raising or lowering this rate, the Fed can make it more or less expensive for banks to borrow money, affecting how much they lend to businesses and consumers. The discount rate, which is the interest rate at which commercial banks can borrow directly from the Fed. It serves as a backstop for banks that cannot obtain funds elsewhere. Lowering this rate encourages banks to borrow more, while raising it has the opposite effect. Reserve requirements, which are the amount of funds that banks must hold in reserve against their deposits. By adjusting these requirements, the Fed can influence the amount of money available for lending. Lowering reserve requirements frees up more money for banks to lend, while raising them has a contractionary effect. Open market operations involve the buying and selling of government securities in the open market. When the Fed buys securities, it injects money into the banking system. When it sells securities, it withdraws money. These operations are a powerful tool for influencing the overall money supply. The Federal Reserve's existence and its role in the economy have been a source of debate since its inception. Supporters and critics engage in a lively and often heated discussion about its effectiveness, accountability, and impact on various segments of society. Supporters of the Fed point to its track record of maintaining price stability and mitigating financial crises. They argue that the Fed's independence from political pressure is essential for making sound monetary policy decisions. They credit the Fed with preventing runaway inflation, smoothing out economic cycles, and acting as a lender of last resort during times of financial panic. On the other hand, critics of the Fed argue that it is unaccountable, opaque, and prone to policy errors. They point to instances where the Fed's actions have exacerbated economic problems, such as inflating asset bubbles or delaying necessary market corrections. Some critics advocate for greater transparency and accountability, while others call for a fundamental overhaul or even abolition of the central bank. The debate over the Federal Reserve is multifaceted and often reflects broader ideological differences about the role of government in the economy. It's a debate that is likely to continue as long as the Fed remains a powerful force in shaping the financial landscape. The Federal Reserve operates under a dual mandate from Congress to promote maximum employment and price stability. This dual mandate presents a constant balancing act for policymakers, refers to a situation where everyone who wants a job can find one without putting upward pressure on wages and prices. It's a state of full resource utilization in the labor market, refers to a low and stable rate of inflation. When prices are stable, businesses and consumers can make informed decisions about spending, saving, and investment. High or unpredictable inflation can erode purchasing power and disrupt economic activity. The challenge for the Fed is that these two goals are not always aligned. For example, policies that stimulate economic growth and reduce unemployment might also lead to higher inflation. Conversely, policies aimed at controlling inflation might slow down economic growth and increase unemployment. The Fed must constantly weigh these trade-offs and make judgments about the best course of action. There is no simple formula for achieving the dual mandate, as economic conditions are constantly evolving, and the effects of monetary policy can take time to materialize. While the Federal Reserve's mandate is primarily domestic, its actions have significant global implications. As the world's largest economy and the issuer of the global reserve currency, the United States holds a unique position in the global financial system. The Fed's monetary policy decisions can influence interest rates, exchange rates, and capital flows around the world. For example, a decision by the Fed to raise interest rates can lead to a strengthening of the US dollar, making US exports more expensive and imports cheaper. This can have a ripple effect on other economies, particularly those with close trade ties to the United States. The Fed also plays a critical role in international financial cooperation. It coordinates with other central banks, participates in international forums, and provides emergency liquidity to foreign financial institutions during times of crisis. The global reach of the Federal Reserve underscores the interconnectedness of the global economy. Its actions, while intended to achieve domestic objectives, can have far-reaching consequences for businesses, investors, and policymakers around the world. The financial landscape is constantly evolving, and the Federal Reserve must adapt to new challenges and opportunities. Technological advancements, globalization, and the emergence of new financial instruments are just a few of the factors shaping the future of finance. One area of focus for the Fed is the rise of digital currencies and blockchain technology. The Fed is exploring the potential benefits and risks of central bank digital currencies, CBDCs, which are digital versions of a country's fiat currency issued and backed by the central bank. CBDCs have the potential to increase efficiency, reduce costs, and expand access to financial services. Another challenge facing the Fed is the increasing interconnectedness of the global financial system. The Fed must navigate a complex web of relationships with other central banks, international organizations, and global financial institutions. It must also adapt to the growing influence of emerging market economies. As the financial system continues to evolve, the Federal Reserve's role will undoubtedly change as well. The Fed's ability to adapt, innovate, and anticipate future trends will be crucial to its continued success in fulfilling its mandate and maintaining a stable and efficient financial system. The Federal Reserve's journey from its secretive beginnings on Jekyll Island to its current status as one of the most powerful central banks in the world is a testament to its enduring influence on the American economy. Its actions have shaped the course of financial history, from navigating the tumultuous waters of the Great Depression to steering the economy through the aftermath of the 2008 financial crisis. The Fed's legacy is one of both power and responsibility. It wields immense influence over the financial system, with its decisions impacting businesses, investors, and consumers alike. Its mandate to promote maximum employment and price stability places a heavy burden on its shoulders, requiring a delicate balancing act to achieve its dual objectives. As the financial landscape continues to evolve, the Federal Reserve will undoubtedly face new challenges and opportunities. Its ability to adapt, innovate, and anticipate future trends will be crucial to its continued success in fulfilling its mandate and maintaining a stable and efficient financial system. The debate over its role, its powers, and its accountability is likely to persist, reflecting the ongoing tension between the desire for economic stability and the inherent risks of centralized power in a democratic society.